Hey everybody, this is David Skrika. So we're going to look at the LQD and a couple other trades here. So I'm probably going to do the Patreon launch, on Thursday. So because what I'm going to do is I'm going to have a special Patreon only / members only video on Thursday. It's kind of a bonus when we launch this, just because of what's happening in the market and interest rates. So I'm going to delay it one more day. I don't think hey, you're going to get stuff for free for one more day. So who's going to complain about that, right? So let's look at this here. So we know we just inverted. So I've averted a government shutdown, and the federal debt after that went up 275 billion in one day. That's like one, that's almost 1% of GDP, because GDP is 25, trillion roughly. And 2.5 trillion roughly is 10%, and because obviously now they're paying all the employees, this and that. So this is another reason rates are going higher. No one's talking about this. The government's spending too much money. There's too much issuance of debt coming onto the market, and rates are a lot higher now. So, but what we're going to really talk about is, I've talked about for years the big short trade being the LQD. So the LQD, you can see this is investment grade corporate bonds, and of course, all corporations went on a borrowing spree when essentially rates were zero, back in 2020, 2021. And for years and years, you can see since the financial crisis, this is an ETF and of an investment grade, which is like, pretty conservative, went up huge, went from roughly $50 a share to 130, plus the yield you're getting on the bond. So, but it looks like it topped out here. And if you go look at these bottoms in 2016, excuse me, 2018, 2020, 2022, is it really looks like the LQD is like, topping out here and about to, roll over. And if we break about this 95 on the LQD, which again is essentially the support going back to almost 2016, a couple points lower. There's some support here under 90, but there's no major support. This is the kind of thing, in my opinion, could crash, because if these rates keep going higher, and the Fed is still remaining hawkish, right now, and we saw the losses that the banks have, et cetera, et cetera. And this is the kind of losses that they have, that if you were buying bonds back here at 130, you got over a 20% loss. And you thought this investment grade, and these things were only yielding 2-3% up here, or 2% up here. So it's going to take you to 20% loss, 2% yield. It's going to take you 10% 10 years of yield to get that back. So, and it all has to do that there's just too much debt everywhere, corporate, private, individuals, government, etc. If we go look at the TBT, which, of course, investment grade corporate bonds are going to have to, yield more when, this is TB, this is short, the TLT is the long, we're at the lows since, not seen since 2013 in the TLT. So of course, corporate bonds are going to go down because they have to yield more to compete with government bonds, which are yielding more. And if we go look at the TNX, which is the 10-year bond, you can see here, this is multi-decade high stuff here. We're going to go back 20 years. Yeah, this is the highest really since pre-financial crisis. And the short-term yields, the IRX and Fed funds, they're at the highest since, pre-dot-com bubble. So, and there's a lot more debt in the system than there were pre-dot-com bubble, right? So I think the government debt, the GDP pre-dot-com bubble was like, 40 to 50%. Now it's, that 33 trillion, which I just showed. Now it's, now it's 100 and whatever, 20%. So it's a big difference. So let me give you like two examples of what this looks like on individual securities. This is a McDonald's bond, which expires in 2028, which is issued in 2018 when rates are still pretty low, right? So we can see the issue price is 99. The yield is 3.8%, et cetera, et cetera. Now, when rates went to zero, it looked pretty good, getting 3.8%. So this bond ran up to $117. Since then, it's fallen, and now it trades at $93 and is issued at 100, right? So now it's down 7%. So this is what's happening to all these bonds. All these bonds were issued from 2018, 2019, 2020, 2021, when interest rates were ultra low. Now interest rates are coming up, and these bonds are off 20, 30% from their highs. And people were buying this stuff, by the way. You know, look at, you can see a big trade went through right here when it was 104. Well, that person is now down, 11%. The thing only yields 3.8, and it yield less, by the way, at 104. Probably yield more like 3.5. So you're down 11% at 3.5. It's going to take you 3 years of yield to get back again your capital. This is the 3M bond, and we got this going back. So this is a March 2037 bond. It was 5.7% long-term bond. Look at the 10-year chart here. That was, this is issued way back, in 2013, and when rates were essentially first starting to go to zero, right? So you can see this thing. Actually, I don't even think that it's actually longer than that. This is probably maybe even issued in 2027. This might be a 30-year bond, because 5.7% is a lot higher. But what you can see is these things are issued at 100, right? And this thing ran up again to 150, since at the top here in 2020 when rates were zero. Now it's $100 a share. It's lost 33%. This is a investment grade, large cap company, and it's down 33%. So that just tells you what's going on here. From that. Oh, actually, now we can't go back. Yeah, it was issued in 2007, like I said. So you can see he issued at 7 and went up huge twice. Again, when rates went to zero each time. But now it's back to where it was when it was issued, right? So, but anyone who bought it here, again, when you're buying it here, remember there's an implied yield. You're not getting that 5.7%. Your yield's a lot lower on the higher bond price. So that's the issue right there too, as well, is, or you're paying the higher price to get that yield. Well, now you're down huge. And people were buying these things, when, when someone would buy it here and pay 50% premium because they're like, oh, I'm going to get the 5.7% and yield rates are zero, so I'll pay the 50% premium. Well, guess what? Now you're down 33%, and it's going to take you 5 years of yield to get that back. So that's what's happening everywhere. And then, like I said, these companies don't mark to market anymore, so they're not reporting these losses. So anyone who bought the 3M bond, from, basically 2008 or 2009 to the present is now down on this investment, but they don't have to mark it down yet. And they got rid of mark to market because mark to market is one of the things that caused the financial crisis, et cetera, et cetera. So I just wanted to show you this. So that's why I think, at some point here, this LQD trade is really going to work out. Because I don't know if I think some of you who write me personally, I haven't put a trade on officially in the newsletter as of late, but some of you who write me ask me about it. I'm like, yeah, buy some March 99s or 100s, and just see what happens here. At the very least, I think this will go lower. And this has a chance to get out of control, because one problem with corporate bonds too is they're not overly liquid. Again, look at this McDonald's chart. Look at the volumes. It's like, these things don't even trade. Most people just buy these things when they're issued and hold them. And it's like, boom. It's like 2 trades. These are monthly, but it's like this thing trades like 1 month out of 2 months out of the year, So the people that are stuck holding them are stuck, and they can't really sell them. And then they'll have huge losses, which they'll finally book in when these things expire. And you can see this one expires in 2028, et cetera. So, but I don't really care, if you don't book those losses short term. You don't have to book them on your books. The issue is if you're a bank or financial institution, you own this, and say this thing ends up being down 50% on the coupon price, it's going to be like, you're not going to lend out money if you're a financial institution. You're going to be like, we've got all these bonds that we own that are, have ravaged our balance sheets, and we're just not going to lend money. So that's how you get a credit crunch, right? So anyhow, I just wanted to show you, and this is how it really affects. And I think, again, like, and we'll do this in our Thursday, like our kind of for Patreon members. What really worries me and has worried me the whole time of what happened in the markets here. I don't like how interest rates have been going higher, all summer. We'll get a shorter term chart to show this. We're just going to 1 year chart. I don't like how the interest rates have been going higher and, to 4.8%. And then whatever, and you can see they were moving higher all summer. And that's what happened in 87, 29, etc. The interest rates go higher, and the market's still ignoring it. Like you look at like the S&P right now, you can see it. Okay, we're right at the moving average here, and it has come off, but it's like the S&P basically kept moving higher. It was rates moving higher until like late July. And I just think at some point it's going to really turn into a carnage. Now, will it be one of these classic October crashes? That's why I'm very defensive now. I'm almost all cash. I got a couple put options. I have a few longs because you can never predict these things exactly, But I think if we break this 200-day moving average here on the S&P, we'll get the QQQs. You can see the NASDAQ. On the NASDAQ is much higher above it, but we break this first support level here at 350. I do think there's a real chance that something could happen. And like whatever, be defensive for a month. Crashes always happen October into maybe the first couple of weeks of November. If it doesn't happen by then, you can close out the positions, you can go long again or go neutral and see what happens. So, I'm very defensive at the moment. I just wanted to show you what's going on with interest rates. I wanted to show you like these corporate interest rates, how this could lead to some carnage. Remember, there's going to be some kind of financial institution that is way overweight these bonds, who thought getting a McDonald's bond or a 3M bond with this kind of like half decent yield in 2020 when rates were zero, they thought that was a great idea. And then they're going to like almost get a margin call on that. Something like that's going to happen. So, okay, let's go to our sponsor company. So this is a company that's very near and dear to my to heart, as they say, is Nevada King. You can see the big jump in the stock here recently. They had some superb results. So I actually I worked with a friend of mine named Chris Krupe. He used to be the CEO of Meadow Bay and Paramount Gold. And Chris, he sold a major property in Paramount Gold to Coeur d'Alene in Mexico. And then Chris also owned this, right? And you can see this here. They have some great results here. This like 108 meters of, 11 grams per ton gold, which included like 29 meters of 37 and 3 meters, 162. These are like fantastic results. And this Atlanta mine used to be a past producing mine, has a resource, etc. And like I said, I helped sell them the property. So that's my bias here. So I really want this thing to work out because I was like, kind of like help set the whole thing up. I still own shares in it. Me and my family, we still own shares in it. Their sponsor, the stock chart of the day. So that was great. And you can see even in this crappy gold market, this thing really popped up here. Even look even further. So I'm going to get really, it's been trading in that Nevada King. So most of you are right about like the IPO I got people into is right about here. About, I'm sorry it hasn't done anything, but the gold market's been terrible for 2 years. But I would think that if you can break this 50-cent level and especially this 55-cent level, we'll be really off to the races in Nevada King. And maybe we can go up to, 80 cents or something like that. And again, I'm not chasing anything here. I still think gold might end up weaker if I'm right that the market has some kind of continued decline in the next month or two. I think that if that happens and it gives some weakness in Nevada King with these great results that came out, you really want to look at that. So I'm going to leave it here. So we looked at corporate interest rates today. We looked like the potential issues that financial institutions could be happening with the corporate bonds. When you really look at stuff like those 3M bonds and those McDonald bonds, you really see, wow, these corporate bonds, and these are investment grade stuff, right, have really dropped a lot. And this could really lead to something bad, So I'm going to leave it at that. And like I said, Thursday, I'm probably going to put out a nice overview of the markets in the first paid Patreon kind of release, and we'll probably launch the Patreon on Thursday. And it'll be a bonus because we're still doing the 3-for-1 this weekend. So everybody take care, and I hope you enjoy this update.